Friends, ask yourself one question. Are we watching the beginning of a new bull market, or are we sleepwalking into a historic crash in 2026? If you have been watching the markets over the last 2 months, you know something feels off. We are seeing incredible volatility. We are seeing the darlings of the AI revolution swinging wildly. And for the first time in years, investors are genuinely confused. Today, we are not just speculating. We are going to break down a critical warning from one of Wall Street's most legendary portfolio managers, Dan Niles. He has looked at the data for 2026, and his conclusion is unsettling. He says, quote, "This year is going to be incredibly choppy." He believes the easy ride is over. But he also believes there is a specific way to navigate this chaos. In this video, we are going to break down the 5 specific stocks he believes will survive this turmoil. We will uncover why he thinks the AI bubble is showing cracks, why OpenAI might be in serious financial trouble, and the one macro surprise from Venezuela that could actually save the global economy. This is not just news. This is your survival guide for the rest of the year. Welcome to Invest with Alex. Let's dive in. To understand where we are going, we first have to understand the massive shift that is happening right now in the technology sector. For the last 3 years, the stock market has been powered by one single narrative: artificial intelligence. It was simple. You bought anything with AI in the name, and the stock went up. But Dan Niles warns that this phase is over. We have entered a new phase he calls discernment. Investors are waking up. They are starting to ask the hard questions. And the biggest question marks are hanging over the biggest players. Dan dropped a number in his recent analysis that should stop every investor in their tracks. He pointed out the massive financial commitments of OpenAI. OpenAI has commitments of nearly $1.4 trillion over the next 8 years. That is a staggering amount of money. The market is now asking, can they actually fulfill those commitments? Because if they cannot, if the revenue doesn't match the hype, the domino effect will be catastrophic. Think about the infrastructure being built. Think about companies like Oracle and CoreWeave who are building massive data centers specifically for this demand. If the demand isn't real, or if the funding dries up, those infrastructure plays are going to get crushed. Dan reminds us of history. He points out that we are currently in year 4 of this massive AI capital expenditure build-out. If you look back at the dot-com bubble of the late 90s, when that bubble finally burst, the Nasdaq didn't just correct by 10%. It didn't correct by 20%. It collapsed by 78%. Now, Dan is not saying we are definitely going to see a 78% drop tomorrow, but he is saying that the risk is higher now than it has been at any point in the last 3 years. He believes that sometime in 2026, we are going to see one of the marginal players in the AI space fail to get funding. And when that news breaks, when a major AI company runs out of cash, it is going to send a shockwave through the entire market. So if the AI trade is so fragile, why hasn't the market crashed yet? Why is the S&P 500 still up over 80% in the last 3 years? This brings us to the second major force driving 2026, the Federal Reserve and the easy money trap. You see, the market is currently caught in a massive tug-of-war. On one side, you have the fundamentals of AI starting to crack. On the other side, you have the Federal Reserve printing money. Dan points out that the Fed stopped hiking rates years ago and has been cutting them for the last 2 years. But more importantly, in December, they essentially restarted quantitative easing. They are purchasing $40 billion in Treasury bills. That is $40 billion of liquidity being injected into the system. And there is a political angle here that we cannot ignore. In May of this year, we are scheduled to get a new Federal Reserve chairman. Dan's analysis is cynical, but likely accurate. The only way a new chairman gets appointed in this political climate is if they are willing to be dovish. He predicts the new chair will likely want to cut rates by at least another 100 basis points. So this creates a very confusing environment for you, the investor. The market is fragile because valuations are sky high. If you look at metrics like enterprise value to sales or market cap to GDP, we are actually more expensive right now than we were at the peak of the 2000 tech bubble. That is the definition of fragility. But at the same time, the market is resilient because the government is jamming liquidity into the system. This is why Dan calls 2026 choppy. It is a battle between overvaluation and money printing. So, in an environment like this, where you cannot just blindly buy an index fund and hope for the best, where do you put your money? Dan Niles has identified 5 specific stocks that he believes offer the best balance of offense and defense for 2026. These are companies that can survive the AI shakeout and thrive on the liquidity. Let's start with his number 1 pick, and it is a controversial one. Google. For the last year, everyone has been saying Google is dead. Everyone said ChatGPT is the Google killer. But Dan disagrees completely. He believes Google is the clear long-term winner. Why? It comes down to 2 things: data and distribution. Google has massive cash flow to fund their AI war. But more importantly, look at their user base. They have 5 billion users across their ecosystem. They have Android devices in pockets all over the world. They have the Pixel phone seeding the market. While OpenAI is burning cash to acquire users, Google already has them. They have the best training data in the world because they own YouTube search and Gmail. Dan believes that as the hype fades, Google's fundamental advantage in consumer AI will become obvious. His second pick is even more surprising: Apple. Now, many people criticize Apple for being terrible at AI. Siri has been a joke for years. But Dan Niles argues that this weakness is actually their greatest strength. Because Apple is behind, they don't have to spend billions developing a model that might fail. Instead, they can partner. They can sit back and let Google or OpenAI bid for the right to be on the iPhone. But the real reason to own Apple in 2026 isn't AI software. It is the hardware supercycle. Dan compares this moment to the iPhone 6 launch. Do you remember when Apple finally moved from the small screen to the large screen? That form factor change drove a massive upgrade cycle where revenue jumped 28%. We are about to see that again with foldable phones. Apple is finally entering the foldable market, and with an installed base of over 2 billion devices, this upgrade cycle is going to be a cash machine, regardless of what happens with AI. His third pick is a classic defensive play: Cisco. In a market where tech stocks are trading at 30 or 40 times earnings, Cisco is cheap. It is trading at around 19 or 20 times earnings. This gives you a safety net. But it is not just a value trap. As companies deploy AI, they are realizing their old networks cannot handle the traffic. They need to upgrade their infrastructure. This is where Cisco wins. Dan predicts their AI infrastructure revenue is going to triple from $1 billion to $3 billion this fiscal year. It is a way to play the AI boom without taking the risk of a high-flying software company. Next on the list is a turnaround story: Nike. Nike was a disaster last year. The stock was a loser. The previous CEO tried to change the business model, alienated their partners like Foot Locker, and let competitors steal market share. But that is changing. A 32-year Nike veteran, Elliott Hill, has returned to lead the company. He is taking Nike back to its roots, sports, and innovation. And the data shows it is working. In the US, revenues have swung from being down 11% to being up 9%. That is a massive reversal. With China potentially recovering, Nike offers a low valuation with huge upside potential if the brand heat returns. And finally, he remains bullish on Boeing, continuing the theme of industrial recovery and monopoly power. Now, before we wrap up, there is one final piece of the puzzle. A macro wildcard that almost nobody is talking about, but it was a key part of Dan's thesis: Venezuela. We have seen significant political shifts in Venezuela recently. Under the socialist regime, their oil production collapsed by nearly 80%. But Dan believes that with the changing political landscape, that production is going to come back online. Why does this matter to your portfolio? Because oil is the fuel of the global economy. If Venezuelan supply returns to the market, it pushes oil prices down. Cheap oil acts like a tax cut for the entire world. It lowers inflation, it puts money back in consumers' pockets, and it helps emerging markets. This could be the deflationary force that allows the Federal Reserve to keep cutting rates without causing hyperinflation. So let's summarize the roadmap for 2026. It is not going to be easy. The days of buying everything and watching it go up are over. We are facing a potential shakeout in the AI sector, where the losers will go to zero. We are facing a market that is historically expensive, but we also have a Federal Reserve that is determined to keep the system liquid. The strategy is clear. Be discerning. Don't chase the hype. Look for companies like Google and Apple that own the distribution. Look for value in infrastructure like Cisco. And watch the oil markets closely. The investors who survive 2026 will not be the ones who take the most risk. They will be the ones who understand the difference between a bubble and a business. I hope this analysis helps you navigate the choppy waters ahead. If you found value in this deep dive, make sure to subscribe, because we're going to be tracking these predictions every single week. I'm Alex, and this has been Invest with Alex. Stay disciplined, and I will see you in the next video.